Welcome to this strategic guide on the Portuguese tax system for businesses. This manual has been carefully prepared by corporates specifically for entrepreneurs and investors looking to navigate Portugal's fiscal landscape with confidence and strategic foresight. Let's explore how you can turn tax obligations into opportunities for your business. Corporate provides an informational overview of corporate development and financial stability in Portugal. This guide outlines the standard frameworks for accounting, human resources management, and general fiscal documentation to assist business entities in understanding the local landscape. Let's look at corporate income tax, known as IRC, which applies to a company's taxable profit. To attract foreign capital and enhance business competitiveness, the state is executing a gradual reduction strategy. The general rate moves from 19% in 2026 and eventually targeting 17% by 2028. The Portuguese corporate tax framework offers specific strategic advantages designed to support small and medium-sized enterprises. In 2026, this fiscal architecture features a reduced 15% rate applied to the first €50,000 of taxable profit. This policy is structured to foster capital reinvestment in core operations, encourage sustainable job creation, and systematically improve overall corporate liquidity across the SME sector. IRC compliance involves payments on account calculated from the previous year's assessment and are mandatory in July, September, and December. Additionally, companies are subject to DERAMA, a local municipal surcharge levied on taxable corporate profit that varies by location up to a maximum of 1.5%. A critical area to monitor is autonomous taxation. These are additional taxes levied on specific corporate expenses to discourage non-essential costs. They represent a direct, irrecoverable cost because they cannot be deducted to determine corporate taxable profit. And crucially, they are due even if the company reports a net financial loss. Applicable autonomous rates vary considerably based on the nature of the expense, ranging from 5% up to 50%. Key categories under this regime include light passenger vehicles, representation costs, meals, client entertainment, and undocumented expenses, as well as capital transfers made to tax havens. Moving on to value-added tax, or IVA. Portugal operates with a multi-rate structure based on the necessity of goods and services. On the mainland, the standard rate is 23%. The intermediate rate for catering is 13%, and the reduced rate for essential goods is 6%, with specific regional variations in Azores and Madeira. The Portuguese value-added tax system integrates structured invoicing, periodic reporting, and statutory recovery mechanisms directly into corporate treasury operations. Under this framework, businesses are required to issue itemized invoices using certified software and submit regular tax declarations on either a monthly or quarterly schedule. Furthermore, the system contains standard provisions that permit the recovery of VATs paid on essential operational expenses, serving as a structural element that affects corporate liquidity and overall financial health. Labor taxation requires strict monthly reporting and compliance. Employers contribute a single social tax, or TSU, of 23.75% on gross remuneration, while employees contribute 11%. Additionally, the company acts as a tax substitute, withholding variable IRS from salaries based on published bracket tables. Beyond standard payroll, tax substitution applies to payments for professional services, commercial rents, and corporate profit distributions like dividends, which are generally subject to a flat withholding tax rate of 28%. Furthermore, every year your business must submit the comprehensive IESS declaration, aggregating all accounting and statistical data. The Portuguese corporate tax framework incorporates various strategic incentive mechanisms designed to foster macroeconomic growth, capitalization, and technological advancement. Notable structures include targeted tax credits for productive business investments, operational measures that support corporate capitalization through equity increases, and dedicated incentives aimed at research and development activities. These fiscal instruments function as broad conceptual frameworks to stimulate business development across diverse corporate sectors. The Portuguese corporate environment is defined by structured regulatory frameworks that balance local compliance with sustainable market development. Operating successfully within this economic landscape requires a consistent alignment with standard fiscal protocols and general business practices. Maintaining a clear understanding of these structural elements helps international enterprises establish a stable and compliant operational presence in the region.